we move on to our third panel of the day. Index engagement, how index managers are driving change. We just heard there, of course, about how engagement is a big part of a successful ESG strategy. But does that mean that passive investors have to live with companies that do not meet the high environmental, social, governance standards just because that company is sitting in a particular index? Let's find out, and let's find out who's sitting on our panel for this particular topic. Well, I think it's a good time to start. Lauren, could you just introduce yourself for us, please?
Hi, thanks, Mark. I'm Lauren Wilkinson, and I'm a senior policy researcher at the PPI, which is the Pensions Policy Institute. And I've just finished working on the PPI's Engaging with ESG research series. So I've been thinking about ESG a lot recently.
You're in the right place, put that way. Okay, and John.
Right. Hi, everyone. John Howchin. I run the Council on Ethics for the Swedish National Pension Funds, and I've been part of the responsible investment community for about 20 years, I would say. So long-term engagement from my side on these topics.
So 20 years. So you were there right at the beginning when maybe it wasn't as popular as it is now.
No, but a lot of things have changed. It's been a great trip, especially looking, for instance, at the PRI. I mean, we were there when the PRI was started 15 years ago. And I mean, all of this has grown, but there's still a lot to do. And it's been a great discussion, what I've overheard so far. So very pleased to hear. Good stuff coming out.
Matthieu, are you there?
Yes, I'm here. So I'm Matthieu Guignard. I'm a global head of product development and capital market at Amundi ETF indexing and smart beta business line. Definitely ESG is a hot topic in the ETF market, but overall at Amundi. Looking at the flows in the ETF market, ESG ETF represent more than 40% of the flows year to date. So it's definitely a hot topic, and our engagement is definitely at the heart of this ESG approach.
Thank you very much for that, Matthieu, and thank you. Welcome all to this panel discussion. If we could actually stick with you for the moment, please, Matthieu. We've just heard from the very active management side of things, but is engagement just for active mandates? What about passive? What about index investors?
Well, I don't think there is such a difference between active and passive regarding engagement. And that's very interesting to see, for example, that at Amundi, we are definitely a large passive player. We are a leading ETF issuer, but we are also a huge active asset manager. And engagement is dealt overall for the company, be it for active or for passive management, without any difference, actually. And it's not because we hold a stock within an active or a passive mandate that the dialogue we have with the company would be different from that point of view. So we are really holistic in the way we approach engagement regarding that difference between active and passive.
Thank you very much for that. Lauren, in your research, is engagement just for active mandates?
So I would definitely agree that it isn't just for active mandates. Passive asset allocation and investment strategy doesn't necessarily have to mean passive asset ownership. So passive investors should definitely be engaging just as much as active investors in the assets they're invested in. We're seeing stewardship and engagement an increasingly important part of any ESG strategy. But passive investors might be less likely to engage, I think. I think they sometimes shy away, perhaps, not in the case of those big passive investors, but certainly in terms of the schemes and how they engage with their fund manager to kind of push their views. I think investors with diverse portfolios and small allocations to a really broad range of different investments, such as those in passive strategies, might not feel that they're adequately incentivized to undertake ESG engagement with those investee companies, and might not think that it will have a very big impact on their portfolio. But in terms of that overall performance, I think engagement across the board of the companies they're invested in can have a really big impact. both in terms of risk management and returns for the scheme and the fund, but also in terms of, broader societal aims when we look at ESG.
Thank you very much for that, Lauren. And John, well, proof in the pudding, you've been doing it. How easy is it to engage as a passive investor?
Oh, I think we have a bit of a reputation. We've been doing it for so long. The council is 15 years old now, and when we started engaging a long time ago, I think we're one of the few very large asset owners that were engaging across the world. I mean, we are, per definition, the universal owner. We own a small piece of everything. And so we engage both on a company level, on a sector level, but also on sort of a topic level. And we find it really important that there's this sort of norm setting within the whole markets, the whole index, not only individual companies, but that it becomes a responsible market. There's a bigger driver here as well. And we obviously want more companies to join the listed market community, but there will be a price to that. You would need to become responsible. There's a hygiene level to be added to this. And I think we and many other asset owners and great asset managers are driving that change. But I mean, we're going to be here for 50 years. So we're by definition the long-term owners.
Good point. But my issue with the sort of the passive investing and engagement issue is this. I mean, you don't have the ultimate threat of selling a stock. And if that's not hanging over at the board's heads, how effective can you really be in creating change?
Well, I think you can be. I think my feeling is that companies have started to listen to institutional investors much more extensively than what they used to do a long time ago. And I think companies are quite keen to understand what their investors want. I mean, on the flip side, I think they can feel sometimes it's a bit of an overload. They get maybe too much information, which is okay. I think the great companies know how to distinguish between this. But my preference would still, I mean, on the other side, you have a free rider issue as well. You should, if you want to be a participant in this responsible listed market, you need to engage, irrespectively if you have the threat of divestment or not. So everybody needs to push their part of the envelope to the discussion. But there are plenty of people who divest. There's whips and carrots all over the place. As long as you add something, that's okay.
Thank you very much, John. Matthieu, bringing you in here on the same theme, about how easy is it to engage as a passive investor?
That's definitely a fair question, and one could think originally that because passive managers are not able to sell the stock as long as it is in the index, their power in engaging with companies could be weakened by this. However, you can turn the argument also the other way around and say that because you stay invested in the company, you are still able to carry on engaging with that company. You are still able to vote against all the resolutions you believe you should vote against, and therefore put even more pressure on that company than you could put if ever you had disinvested from that stock. So in the end, engagement is more efficient on the long run. So if you stay invested in that company, whatever the reason, because it can be because you have selected the stock as an active manager, or because that stock has been selected by the index provider for which you the index. But the longer the investment and the more efficient the engagement can be. And in the end, I also believe that a company that would, let's say, misbehave from an ESG standpoint would also, in the end, be less well rated than another company, and in the end would also exit from the indices. So there would still be a consequence of that misbehavior from the index provider. So I think it's very interesting to see that at both levels, asset manager and index provider, there is also this consistency in the way engagement can put pressure on companies.
So that's actually quite a good point there to sort of to end on there when you talk about putting pressure on companies. And I am reading a lot about a lot of investors, especially on the passive side, working together, clubbing together with a unified voice. John, is that something that you're doing? Are you working together on engagements with other investors?
So absolutely. I've been chairing the engagement program at PRI for 5 years previously. So I mean, it's all about leverage, isn't it? And to Matthieu's point, I think it's a question of what you raise on the engagement. Engagement is all about having reasonable expectations on what kind of outcome you want. If you have unreasonable expectations, I think you will find engagement being quite problematic. If you have too easy expectations, obviously engagement will be easy. And it's always a matter of finding the right balance of those expectations on irrespectively of what topic you're raising with the company. And then you take a breather for a while, you take a pause, and then you get back while they implement what they're doing. And it's always a staircase. All kinds of sort of institutional ownership is a staircase, and you continue up and onwards. So by collaboration, absolutely. I mean, look at the work that we've done with the Church of England Pensions Board. Adam Matthews and I have done on the mining industry post the Brumadinho accident and the Mariana accident with Vale in Brazil. We've set up a completely new global standard for the mining industry, how to manage waste. And it's 700 mining companies, listed mining companies globally together in that. And we've had a huge backing. I don't know how many trillions of passive and active managers behind that money. And it's a large pool of mining companies participating in this. So obviously, collectively, we can become very strong as long as we ask reasonable requests and we get results that are doable. You know, people can actually implement it and you get an outcome out of it. So absolutely.
Thank you. And Matthieu, what are you seeing? Are you seeing a lot of collaboration between various investors in this space?
Not necessarily I would say an official collaboration. However, we see some consensus that are coming at the index level, especially in the way we design methodologies or we ask index providers to design methodologies regarding exclusions. For example, the tobacco exclusion was not necessarily a consensus 2 years ago. It is now excluded from almost all the ESG indices. So this is the result of the consensus between index providers, asset managers, and of course clients, because in the end we design indices that clients demand. So we don't do anything on our own. So this is the way this kind of collaboration.
Okay, thank you for that. Lauren, bring you in. Is engagement necessary, and why don't people invest in better behaved companies and index just be made up of better behaved companies?
Yes, I think engagement is a vital part of any investment strategy, whether that's passive or active. And I think the investment landscape is really complex, and ESG is becoming increasingly important. Every investment can have various ESG risks to a lesser or greater degree. And so I think investors need to do more than just accepting the binary of either accepting ESG risks within the companies they're invested in or divesting from them. Across the board, there's such a broad range of ESG considerations, and there's a lot of interactions between, the different environmental, social governance. And there's a lot more nuance, I think, than can often be captured by simply an ESG rating. So engaging with companies, getting better data about them, making sure that the data that they have enables them to carry out their duties in terms of reporting on their ESG behaviours, I think is really, really important. And greater engagement with investee companies could open up a broader range of investments that might otherwise have been excluded, and obviously adding a bit of risk mitigation there through diversification. So I think really engagement just broadens the landscape and really brings up the bar of ESG behaviour. So rather than everyone investing in the best behaving ESG companies, it's improving the behaviour of everyone. And I think, given that complexity that I've referenced, it's not as simple as saying this is somebody that behaves well on climate, because there are a lot of companies that are the biggest carbon producers, but are actually doing the most to work towards, alternatives in terms of energy. So it's more complicated than just divesting or investing in the best ones. And I think engagement is a really vital part of that, of kind of having a better understanding across the board and just improving those standards across the companies, across the investment landscape.
Okay, thank you very much, Lauren. Thank you. John, you've been doing this now, as you said, it's either for 20 years, and things have changed, things have got easier. Company boards are a lot more receptive now to conversations with the funders and exactly how they should be operating. But if it gets to the point where you're voting against the management of the board at an AGM, is that a sign that engagement isn't working or has failed?
Well, it could be, not necessarily. I think it could be a sign. It's a tricky one, I would say. So in some ways it could, but I think you need friends, you need leverage. I think we're building a strong collective together, and quite frankly, the collective that we're building, it doesn't matter if you're passive or active, as long as you participate and you're not a free rider in the system. As to my initial point, I think that was the purpose with the PRI, that we all should share that burden. I mean, not just to siphon off the system, but if you join and you make money off the system, you sort of pay a small fee to participate. Because if you do that, we all get leverage together and we collectively put pressure on companies. And I think that sort of understanding has been growing quite rapidly. And I think many investors are participating in these sort of groups. Some of them are very activist, and you need to be mindful, obviously, but it's a learning curve. And I don't think, to Lauren's point, I don't think there's sort of an option. You need to learn how to be active, and every group needs to learn what suits them, And especially, I think it's quite important now, because I think many responsible investors have made sort of net zero commitments, and that means they will start divesting from a lot of companies that are in dire need of ownership, companies that will not disappear. I mean, tobacco has been divested, the most divested company for a very, very long time, but we still have very big tobacco companies, and the tobacco companies needs active owners. They have a lot of issues. Apart from that, them making tobacco, they have a lot of issues with child labor and what have you. So I'm a bit concerned that we will have a number of very socially important companies that will not have responsible active investors. So this is a call for the passive investors to start picking up that, because you will be the ones running those companies.
So thank you, John. Thank you. Matthieu, is voting against companies at AGMs part of the engagement process, or is it a sign that it's just not working?
No, for me, it's really part of the engagement process, and just the continuity of that engagement process. I would say, just as war is another way of making diplomacy. I mean, if you are not able to make war, your diplomacy is not as efficient. And I think here it's about the same topic. Voting is really the continuity of this dialogue we have with companies. It's not always about the same exact topics, but I think it's a very efficient lever on companies to really make sure they listen to the recommendation we ask them to follow. So it's really the two parts of the same process for me.
Thank you very much there. Thank you. time is catching up with us. We're into the last 4 minutes or so. Now, during this discussion, you guys might have actually touched on this in various of your answers, but I think that'd be a good idea just to end on exactly what is needed for a successful engagement to get it over the line, because these things do take time. I've heard that it can take 3 or 4 years to achieve something in a company. So, John, could we start with you? Could you just give me a sort of an update on what you think is needed for a successful engagement?
So, back to my previous point, I mean, you've seen a number of large investors within the Climate Action 100 Plus now engaging with the oil companies. And I mean, that's a pretty big ask to ask the oil companies to become something else but oil and gas companies over time. So that's a very difficult engagement. And you need to be a bit humble when you do that kind of engagement. Whereas, getting a company to implement an updated human rights policy due to them having some human rights risks within the supply chain that you've identified and where they've had issues, that's a much easier task these days. So it all depends on what you set out. I mean, some engagement you can do in 5 minutes, to be honest, and some engagements you can spend 5, 10, 20 years doing. So having that sort of reasonable expectation on the aim sets the whole agenda. I think you should try both. But you probably need to be a bit experienced, and you need a few wins. So maybe you start with the easier low-hanging fruits and feel comfortable and collaborate with others. That's my recommendations, if you haven't done this before.
Thank you, John. Thank you very much for that. Thank you. Matthias, same sort of question, really. What's needed for a successful engagement? Because it does seem to me that there are limitations, especially with some of the points that John just touched on there.
Well, I think one very important point is also to have the kind of consensus I talked previously about, and I think regulation can also help finding those consensus on what are the, let's say, positive activities, what are the less positive activities. I think the whole debate about taxonomy that is currently conducted by EU is a very interesting one to create also that kind of consensus on the virtuous activities. So this will again help converging all the efforts on the same topics. Because again, the more shareholders we put and push in the same direction on companies. And I think what we start also to see, and that is very interesting right now, is that there is a kind of momentum where the flows that we see in ESG investment products really show the credibility of all this ESG approach, and start to put this virtuous circle in place, where investors buy ESG products, asset managers managing those products are able to put more pressure on companies in their engagement dialogue, and companies change their behavior at the end, and therefore get better ESG ranking, and are therefore overweighted in the portfolios, be they active or passive once again. And I think we are really at that moment.
Great news, great news. Thank you very much, Matteo. Thank you very much. Time is against us, unfortunately, so we haven't got any time for any more. But again, a very, very different conversation we had from the last one. So thank you very much for that, guys. John, Lauren, and of course, Matthias, thank you very much for your time, guys. Thank you.
Bye-bye.
Thank you.